As of the close of the market on Friday, July 17, 2026, Micron Technology closed at exactly $848.95, marking a modest intraday decline of 0.50% after fluctuating heavily between an opening low of $804 and an intraday peak of $903.96. While a 0.5% drop sounds mundane, the volatility underlying that massive swing tells the true narrative. This single trading day captures a massive disconnect in the market right now, showing how a stock can touch its highest valuation and then shed a quarter of its value in less than a month without a single piece of bad news originating from inside its own boardroom. The immediate insight that long-term investors need to realize right now is that memory chip manufacturing has detached itself from the traditional consumer hardware cycle. The street is evaluating this business under a completely different framework where structural constraints on fabrication are clashing violently with macro geopolitical positioning. Even as the company projects massive multi-billion-dollar scale expansions over the next decade, the capital required to keep pace with modern technical requirements is forcing a major reappraisal of intermediate corporate cash flow. The collective expectation surrounding the company is straightforward. Most retail market participants look at the hardware space and assume that massive corporate demand for processing units will automatically float all boats in the semiconductor sector indefinitely. They see blockbuster earnings reports, look at the immense backlogs for high-bandwidth memory products, and assume the trajectory is a straight line upward. This general optimism leads people to pile into individual brokerage accounts on platforms like Robinhood or SoFi Invest, hoping to capture a simple momentum play. However, the cold reality of the situation is far more nuanced than the standard headline narrative suggests. The semiconductor landscape is famous for its punishing capital expenditure requirements, and the market is suddenly waking up to the fact that maintaining leadership in high-bandwidth configurations requires billions of dollars in upfront investments before a single unit ever ships to a customer. When major global players lift their capital forecasts, it creates a massive supply anxiety across the broader tech ecosystem. Institutional funds using interactive brokers trading systems or navigating the Fidelity trading platform are increasingly discovering that a company can deliver its strongest operational numbers in corporate history, yet watch its stock get punished as the broader market corrects sector-wide valuations. Let us unpack the trading dynamics over the last few sessions, because this is where the real narrative lives. The stock experienced a steep 26.5% decline from its midsummer high of $1,154, driven heavily by external macro factors rather than operational execution errors. One major source of friction came when global foundry giant TSMC adjusted its annual spending projections upward to a massive range between $60 and $64 billion. While that capital increase speaks to the massive scale of hardware demand, it triggered immense valuation anxiety across the entire sector. Institutional funds quickly realized that higher capital investments mean tighter free cash flow margins across the board, sparking an abrupt rotation out of high-flying semiconductor names. Compounding this pressure was the public market activity of major global competitors. The long-anticipated public listing of South Korea's SK hynix created a direct pipeline for domestic institutional capital to flow into Micron's chief competitor, ending the near monopoly on U.S.-listed high-bandwidth options. Simultaneously, reports that a major domestic competitor in China is looking to raise massive public capital via an initial public offering signaled that long-term supply dynamics are becoming much more crowded. When you look at the options activity and order flow on major institutional investing sites, the massive short positions entered by prominent hedge fund managers highlight a deep skepticism about whether current pricing power can be maintained over a multi-year horizon. If you are managing your own holdings through an individual brokerage, whether that means utilizing automated platforms like Schwab Intelligent Portfolios or executing direct trades through Fidelity Investments, you have to look past the day-to-day noise of the options market. Comment below how many shares of Micron Technology you currently hold in your portfolio and whether you're buying this recent dip. The trading volume over the last month demonstrates a significant institutional reassessment as the stock slipped below its 50-day moving average and turned former key support levels into tough near-term technical resistance. Yet while the short-term chart looks bruised, the underlying fundamentals tell an entirely different story. To fully understand why this disconnect is so massive, it helps to review the structural foundations of the business model. The corporation operates primarily in two main segments: dynamic random access memory, commonly known as DRAM, and NAND flash storage. These two technologies form the absolute bedrock of modern computing infrastructure, acting as the critical bridge that allows high-powered processors to read, write, and store data at lightning speeds. In their recent financial reports, the organization delivered a jaw-dropping performance, bringing in $41.46 billion in revenue for a single quarter, which represented a stunning triple-digit increase compared to the previous year. Gross margins expanded to a record-breaking 84.9%, highlighting the incredible premium that companies are willing to pay for advanced hardware nodes. Historically, this has been a notoriously boom-and-bust business. For decades, memory manufacturers would build massive fabrication plants, flood the market with chips, cause a severe price collapse, and then suffer through years of losses until demand caught up with supply. This historical volatility is exactly why legacy investors remain so hesitant today, and why short sellers look to bet against the stock during rapid expansions. However, the core of the current bull thesis rests on the idea that this structural setup has changed. The design of next-generation infrastructure requires a specialized type of memory stacked directly onto processing units, a process that is far more complex and yield-limited than building standard desktop or smartphone memory modules. Management has emphasized that their capacity for these specialized high-bandwidth products is entirely spoken for through the next consecutive calendar years under binding, non-cancelable customer agreements. Furthermore, the management team has actively sought to diversify their revenue streams away from a pure reliance on the massive data center build-outs. Just recently, the company finalized extensive strategic agreements within the automotive tech sector, partnering with global automotive suppliers and electronics giants to integrate specialized hardware into next-generation vehicle architectures and automated transport systems. This strategic expansion ensures that even if data center infrastructure spending undergoes a temporary breather, alternative industrial and transportation segments will act as a stabilizing cushion for corporate top-line growth. Looking out toward the future horizon, the strategic outlook for the stock is a classic battle between immediate technical headwinds and massive multi-year visibility. Wall Street analysts maintain an incredibly constructive long-term view, with consensus targets sitting well above current trading levels, suggesting a substantial upside potential if the company executes on its forward guidance. The company has laid out an aggressive roadmap, projecting sequential revenue targets to scale up toward $50 billion per quarter in the very near term. For retail investors navigating the market via online investing platforms, self-investing applications, or managing wealth through comprehensive Fidelity IRAs, the central challenge is managing the emotional volatility that comes with these deep macro cycles. The primary operational risk is that the massive capacity expansion plans announced by global competitors could eventually outpace the current structural shortages, leading to a normalization of component pricing faster than the market expects. If global spending on heavy infrastructure slows due to broader macroeconomic shifts, high-multiple hardware companies will inevitably face a re-rating. Conversely, the opportunity lies in the fact that the actual physical constraints of manufacturing these advanced components cannot be solved overnight by simply throwing money at the problem. Building new fabrication facilities takes years, requires precise supply chains, and faces strict environmental and regulatory oversight across multiple jurisdictions. When you balance expectation against reality, the overarching market sentiment is currently driven by a fear of a cyclical peak, while the operational reality points to an extended period of constrained supply and high structural profitability. The stock has pulled back significantly, creating a compelling risk-to-reward setup for those who believe the structural transition of the digital infrastructure economy is still in its middle chapters rather than its concluding act. As institutional rotation continues to shake weak hands out of the technology sector, the underlying capacity metrics and long-term customer commitments will ultimately dictate where this equity finds its true equilibrium. Investors must look past the near-term noise of daily market swings and focus directly on the core capital allocation choices that will define the hardware landscape for the remainder of the decade.